Yo, what's going on, everybody? My name is Ryan, I'm a CPA, and today I'm going to be talking about what to do with your inherited money if you were to get inherited money or property. All right, but first, I'd love it if you would subscribe to my channel, smash the like button, and comment below if you have any questions, concerns, whatever it is. All right, so just as a quick summary, inherited money and property. So what does that mean? That means when someone dies, they pass along either cash, real estate, stocks, maybe an IRA account, maybe just like a brokerage account for your stocks, those kinds of things that you inherit. I'm going to talk about what the tax treatment is and kind of what the things that you need to do to really maximize your tax effectiveness for these properties or cash. Okay, so how does it work? What's the mechanics of inherited money? So basically, let's say you have a grandma and she has some money, maybe she has a house, maybe some stocks, and then she dies. Okay, after she dies, what happens? Well, if she had a will, and let's say you were the only family member left, she had a will, then she might have left you with all of her assets. So all the cash, all of her houses or house, all her stocks go to you. Makes it plain and simple. Now, if she did not have a will, then that's when things get complicated, because that's when all of her assets get put into probate. They get held in her estate, and then you go through a process called probate through the courts, and you basically work with the courts to figure out which assets go to who in the family. The important thing that I want to mention is that inherited property means that the person that died fully owns the property before they passed away. This means that they did not transfer the title of their house to their decedents before they died. This means that they did not, send stocks over to their family members before they die. It means that they solely owned the property before they died. And that's very important, and I'll talk to you about that later in this video, why that's so important. So I get a lot of questions as the person inheriting the money or property. First biggest question is, do they have to pay any taxes on this inheritance? And the answer is likely no. You do not have to pay any taxes. So for example, let's say you inherited like $100,000 from your grandma. She passed away, you inherited $100,000, no taxes there. Okay, plain and simple. Now let's say you inherited stock from your grandma. Do you have to pay taxes on the inheritance, on the actual mechanics of inheriting the stock? The answer is also no, you don't. The only time that I might see you paying taxes on the stock is that once you inherit the stock might pay dividends out, and so you'd have to pay taxes on the dividends you receive on the stock after the inheritance already happens. Okay, so that's the only time. And how about a house? Would you have to pay taxes on a house that you inherited? And most people think, well, of course, it's a house, it's such a big asset. And the answer is also no. On the mechanics of just simply inheriting the house, you would not have to pay any taxes on that. And last big thing I get questions about is life insurance proceeds. Person who died had life insurance, $1 million. They left the life insurance to their child. Will the child have to pay taxes on $1 million? Again, the thinking is, of course they do, because it's such a large amount of money. And again, with life insurance policies, if it's a legitimate one, the answer is no, you don't have to pay taxes on the life insurance proceeds. Okay, so I'm going to run through some examples here on what to do when you, let's say, inherit a house, because a house is like something that's talked about a lot, like real estate. Inheriting real estate, you might have heard like there's a step up in basis. I'm going to talk about what that means and how to guarantee that step up in basis. But really the biggest question I get here is, people inherit a house and what should they do with it? Okay, because if you are, let's say you were like, a young adult, your grandpa dies, you inherited a house, should you keep the house? Well, usually it's a house they don't really want to deal with. Maybe it's the house that their grandma's had since the 30s, since the 40s, whatever it is. So maybe you don't want to deal with the house. So you don't want to live there, because it's like 2,000 miles away from where you live now. And maybe it's not such a great house that you want to keep. Well, should you become a landlord and rent it out and make money that way? You should only become a landlord when you're ready to be a landlord. You don't want to be forced into being a landlord and then just rent it out because now you have a house. Especially if you're renting a house from like a different state, that complicates things immensely, okay? So yeah, don't just become a landlord because you have a house now. Only become a landlord when you're ready. And then, so the third option is to sell it, keep it or sell it. And people are afraid of selling it because of, they might be afraid of paying taxes on the gain of the house. So as you can imagine, if your grandma had this house since the 40s, they probably bought it for $30,000, and now, depending on where she lived, it might be worth $3 million. So the taxes on that could be immense, right? Well, not really, because as I talked about earlier, inherited property gets a step up in basis. So if you don't know what basis is the cost of the property when you first purchased it, plus any improvements you made to it, anything that you did to it to renovate it, to add value. That is your basis. So if your grandma bought the house back in the 40s for $30,000, that would be her basis, is $30,000. Now there's this thing that happens in the tax code that when you inherit property, you get a step up in basis at the time of death of the owner. So let's say, your grandma purchased the house for 30 grand back in the 40s, and then she just died last week. The house, the average market comp for the house is $3 million, okay? Now, that means at the time of death, if you get a proper appraisal and your house is worth $3 million now, that means that your actual tax basis as the inheritee, I don't know if that's a word, but as the inheritee, the person inheriting the house, your tax basis is now $3 million. That means if you sell the house for $3 million, you don't pay any capital gains, because capital gains is basically the selling price minus the basis of the property minus any selling expenses. So if you're selling the house for $3 million and your tax basis is $3 million, you pay no capital gains tax on that, which is a fantastic tax rule. So earlier I talked about titling the property to your family member before you die. And this is one example, and probably the only example you need to know why that is a terrible idea to do that. Because if your grandma bought the house in the 30s for $30,000 and then titled it to you before she died, that means she's giving it to you. She's gifted you the house. But when you give property, the tax basis of the original owner transfers to the new owner. That means your tax basis is now $30,000, okay? And if she passes away and you decide to sell it because she doesn't live there anymore, obviously, because, and so you sell it for $3 million and now you have to pay capital gains tax on $2,970,000. And so if she just simply kept the house in her name rather than transfer it or give it to you, you would have saved a buttload of taxes. So in terms of property, if you're talking to your grandma, grandpa, or somebody, you're talking with an estate planning attorney, they will probably recommend that you don't title or transfer your assets to your friends and family, whatever, before you pass away, because of the step up in basis. That could save them a lot of money. Now, this works with stocks, any other properties. Stocks also get a step up in basis when the transfer dies. So is this something that happens automatically? Do you just get to say, hey, somebody died, I get a step up in basis, and we're good to go? Technically, no. Technically, you can't just assume that it's going to be okay if you don't do anything. What you have to do is you have to file a Form 706, which is the estate and generation skipping transfer tax return. There's another estate tax return that I'm not going to talk about in this video, but this is the one you have to file to claim the step up in basis, basically. You got to claim it with the IRS. Can you get away with not doing this? Sure, you can, but the IRS may challenge your basis when you sell the property down the road. So this is something that I recommend you should do, and I would go as far as saying you must do. File this Form 706. Usually the estate planning attorney or your CPA can file this tax return. And this tax return basically just lists the assets of the estate, the the value or the basis, the appraised basis of real estate properties, that kind of thing at the time of death. So that's filing that form basically guarantees your step up in basis with the IRS, so you don't have any troubles down the road. So that's all I got for today. Thanks for joining me. Again, subscribe to my channel if you could, and also please smash the like button on this video if you found this video helpful. And again, comment below if you have any questions, concerns, whatever it is, and I hope to see you next time. Take care, stay safe.
I'm in the mood for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a stick up. She picture perfect, so I told him I'm a flick up. Bill, I'm in the mood for a change up. I leave the city and return with my change up.